Why not have no central bank whatsoever and no authority targeting inflation or growth or employment, and just leave everything to the free markets?
I think that is the question of the moment. And I think we're fast approaching some kind of resolution. Congress farmed out its own responsibility from Article 1, Section 8 to regulate the money to this government agency whose record on delivering stable money has not been very impressive.
It's my pleasure to welcome back to the show Dr. Judy Shelton, Senior Fellow at the Independent Institute, former economic advisor to President Trump, and we'll be talking about her outlook for the economy, what should be done under the Trump administration when it comes to legislation around financial assets, consumer protection, and a very interesting development, which is the possibility of a gold-backed bond that may or may not be introduced. What could that do to our system? Welcome back to the show, Dr. Shelton. Good to see you.
Good to see you. Happy to be with you.
I want to talk about some recent developments here around consumer protection. Take a look at my screen. This is from CNBC. Trump's acting Consumer Financial Protection Bureau chief halts all supervision of companies. Trump recently installed a new head of the U.S. Consumer Financial Protection Bureau and instructed staff on Saturday evening to suspend all activities, including the supervision of companies overseen by the agency, escalating the new administration's efforts to neutralize the government watchdog. Russell Vought also announced on Saturday evening on Elon Musk's social media platform X that he was zeroing in, or out rather, the agency's funding for the next fiscal quarter, saying the more than $700 million in cash on hand was sufficient. I wonder how this development actually impacts consumers. Can you comment on what's going on and your thoughts around this?
I'm extremely in favor of it. I was delighted and posted the letter that Russell Vought, who is the head of the Office of Management and Budget, sent to Chairman Jerome Powell at the Federal Reserve, saying since the Consumer Financial Protection Bureau gets its funding from the Federal Reserve, and we need to notify you every quarter how much we need, I am notifying you that we need zero, and that we have received too many funds, and that the agency is engaged in activities not consistent with the objectives of President Trump. And I just love it. I do not see the CFPB as protecting consumer rights. I see it as infantilizing consumers. And it has a bias of assuming that any voluntary contract to borrow money from a financial institution renders the lender incapable of understanding their contractual obligations. So I see it as a bullying institution. I don't think that it has legitimate funding. It's supposed to be funded by the Federal Reserve so that it's not subject to an appropriation from Congress. So, of course, it's already operating beyond what I think are acceptable parameters for a government agency. But the laughable part is that the Federal Reserve is running at an operational loss, so it has no profits out of which to finance another agency. In short, I would love to see it ended, and I'm delighted that the head of our OMB seems to be aligned with that objective.
Okay, so you're not in favor of the CFPB, which, according to this article, the Congress created in the wake of 2008 to supervise, and I'm quoting this article here, consumer-facing financial companies like banks, title lenders, mortgage originators, cash transfer services to prevent unfair, deceptive, and abusive practices and other predatory conduct. In which way has the CFPB deviated from this original goal, Dr. Shelton?
Well, I suffice to say it is really the pet project of Senator Elizabeth Warren. It was brought about in the aftermath of the global financial meltdown of 2008, and basically set up to make out banks to be financial predators. And as I say, this ties into this attitude of infantilizing borrowers. And I just think that it does far more harm than good, and it does not need to exist. I think that it would be very important to consolidate the regulatory framework that affects financial intermediaries, and getting rid of this institution would be a first step toward doing that.
Well, what should be the correct approach to, I guess, moderating or supervising consumer companies and banks and lenders and making sure that predatory practices aren't common practice?
Well, I'm not sure what you mean by predatory practices. I mean, fraud is fraud. And if you want to file an individual case against a bank for that, then you have the rule of law behind you. But to have a government agency that's somewhat rogue because it is not responsive to Congress, because it brags that it doesn't have to go to Congress for funding, means that it just carries out a separate agenda, in particular that of Elizabeth Warren, who has never met a bank nor any other private business that she doesn't assume is ready to inflict pain and predatory pricing and is out to get the consumer instead of providing for goods and services in a free market economy.
So it has nothing to do with Dodd-Frank, this CFPB.
Well, a lot of things were adopted in the wake of Dodd-Frank that really don't go to the heart of the problem. I mean, here you had the Federal Reserve empowered to calibrate the appropriate level of money and credit for the economy, let alone the world, given that our central bank is the most powerful. And then with no predictions by anyone on the governing board of the Federal Reserve, you have a stupendous crash close to the Depression in terms of its economic negative consequences. And if the Fed wasn't responsible for that, then I don't know what other government agency should be declared responsible. And instead of constraining the fiscal and monetary actions leading to that, we just set up a number of additional bureaus and bureaucratic governance structures that really didn't go to the heart of the issue, which is having sound money that really reflects the level of supply and demand for loanable capital in our economy.
Well, here's a clip from a recent Senate Banking Committee hearing from earlier this week. Take a listen. We'll respond together.
Chair Powell, if the CFPB isn't on the job right now, then who is administering JP Morgan or Wells Fargo's consumer compliance exams to ensure that they are following the law?
Senator, I believe that, and you would know, that Dodd-Frank moved all authority for examinations in the consumer space to the CFPB. We still have some jurisdiction.
If the CFPB is not there examining these giant banks to make sure they are following the laws on not cheating consumers, who is doing that job?
Say no other federal regulator.
No one, in other words.
Let's just respond to that. No other regulators on the job. I mean, can you comment on that? I mean, yeah.
I thought that was a needless concession by Chairman Powell. And you have the Office of the Comptroller of the Currency. You have the Federal Deposit Insurance Corporation. As I say, you have rule of law with regard to fraud or illegal activity by any institution, not just financial institutions. So I think he should not have conceded even the impression that somehow people who put money in a bank are going to be subject to fraud and there will be no consequences for the institution that conducts such fraudulent activity.
Okay, so just to close off on this particular topic, and we'll move on. If you were advising the Trump administration today, what actions should they take to, I guess, safeguard consumer safety? Forget, the assumption that banks are operating under predatory practices, just helping consumers navigate our current economic environment. What should, generally speaking, who should be overseeing this?
Well, are you separating the provision of financial services from any other institution or company that provides goods and services to the public? I mean, you're already saying that there's something different about financial institutions, that people are not capable of deciding whether to do business with them. But as I say, I think the key is to streamline the institutions. We have multiple layers of financial regulation. And for the Fed to say we take no responsibility for the behavior of banks, I find that odd. And that's why I was surprised at that statement by Chair Powell. But mentioning OCC, FDIC, and the Fed itself, I think you can streamline that but to go beyond whatever protections we want to provide through the FDIC and just the legal system that protects private property rights and would investigate any individual offense against a citizen who files a report against a bank or any other institution for fraud. But to call predatory suggests that people were victims of financial institutions. And so far, I think you have to apply for a loan, or it is your initiative to put savings with a bank. So that's the approach that I would take.
Okay, I understand. Let's take a look at this my screen one more time. All aspects of the government must be fully transparent and accountable to the people. No exceptions, including, if not especially, the Federal Reserve. Elon Musk is basically calling for an audit of the Fed. Apparently, it's never been done in history. Correct me if I'm wrong, Dr. Shelton. But can you comment on whether or not, first of all, you agree with Elon Musk? And second, if you do, what should this audit look like?
Well, I definitely agree, but it is not true to say the Fed is not audited. It is subject to a financial audit. It files quarterly uncertified reports, and then an annual financial report that gives both the financial statement and the balance sheet for the Federal Reserve. So that is carried out by an independent auditor. But the audit of the Fed is based on a different set of accounting principles. That is, the Federal Reserve does not abide by GAAP, by generally accepted accounting principles. It has its own approach called the System Open Market Committee approach. It's SOMA. And the way that it defines the value of securities, the way that it accounts for losses on securities, the way it even defines its income statement is not what I would consider straightforward accounting. For example, the Fed has gone from running a profit, basically, from the interest income it gets off its own portfolio relative to the interest it pays on cash reserves held by member banks, and banks are required to be members and hold cash accounts at the Federal Reserve. Up till about 2 years ago, they always earned a profit, and then the Fed was required to remit virtually all of those profits, basically 90%, back to Treasury. But that changed roughly September of 2022. And so now the Fed is running an operating loss, and it is over 200 billion in accumulative losses. But whereas the remittances from the Federal Reserve to the Treasury before, for some 10 years before, if we just look at those amounts, were a total of $1 trillion in revenue from the Fed that then fueled the Treasury budget. It went into revenues for the U.S. government, and congressmen would routinely thank the Fed for this windfall that it provided. It was one of the largest sources of revenue, certainly in the top half dozen to the federal budget. That stopped, but they do not count the accumulating losses as expenditures of the budget. Instead, again, through the accounting fictions that the Fed uses, they call these accumulating losses a deferred asset. And so I think that has totally compromised not just the Fed's own independence, which it likewise, as we talked about the CFPB, the Fed's own independence, as you'll find on their website, has a lot to do with their assertion that they don't have to go to Congress to appropriate funds to run their operation. Well, now they do, only instead they just create what they need to pay off the banks. They're still paying interest on reserve balances to cover their own expenses, but instead of showing that as an expenditure of government, they are recording that as a deferred asset.
President Trump has suggested that the president sit on the board of the Fed in some capacity. Now, this is a hypothetical, of course. He hasn't signed anything like this into action as an executive order, but I'm just wondering whether or not this may be a solution to have members of either Congress or the administration be on the Fed for more transparent oversight.
Well, referring back to that same site on the Federal Reserve's website defining why they are independent within government as an agency, besides the assertion that they fund themselves, which we know is not true, they also say they are independent because they do not allow sitting members of Congress or the administration to serve on their board. But I think it's very important to point out that this seeming prohibition against a revolving door, or that kind of a complicity between the executive or legislative branch with the Federal Reserve, does not work in the other direction. We saw how Janet Yellen went from being the chairman of the Federal Reserve to serving as Treasury Secretary for an administration. We saw that Lael Brainerd, who was vice chair of the Federal Reserve, literally walked out the door and went to the White House and became the president's chief economic advisor, a highly and necessarily partisan position, since she would be the chief economic advisor with regard to defining and implementing the president's economic agenda. So the talk about serving on a board, what I respect about President Trump is he said clearly, I don't think I can order the Fed to decrease or raise interest rates. He said, but I think I have a right to express my opinion. And I certainly agree with that. And I would think that anyone at the Fed would be sufficiently interested to hear the economic ideas or just the opinion with regard to monetary policy of the president. And he doesn't do it in secret. He tells his ideas very openly. I wouldn't shield my ears from hearing that and pay attention instead to the 300 economists who work at the Fed, many of them newly minted from grad school, many of whom have proved consistently wrong. I would say in the aggregate, Fed predictions have not been very impressive. So knowing that the Fed chair meets weekly for breakfast, if not more often, with his Secretary of the Treasury, I think it's kind of silly for people to say that there should be no interaction between the president and the chairman of the Fed. And in fact, if people went back and read the legislation, commonly called Humphrey-Hawkins, from 1977 and 78, together the Federal Reserve Act and the Humphrey-Hawkins Act of those years, contrary to saying that there should be total independence, this is ironic. The word independent or independence is never mentioned in that very lengthy legislation. Instead, it says repeatedly that there should be more integration among Congress, the president, and the Board of Governors of the Federal Reserve. I said that during my own hearing and was accused of being against central bank independence. I said, I am reading your words. I am reading the literal language of the legislative act from Congress that emphasize the need to work together and to have coordination between the president, Congress, and the Federal Reserve.
Okay. Well, let's talk about monetary policy now. This is an article about you, Judy, written by CNN. Right before the election, Trump's former pick to join the Federal Reserve has proposed what they call a radical solution to solve inflation. Judy Shelton, a controversial economist, their words, not mine, who has been floated as a potential pick by former President Trump to lead the Fed if he wins in November, has proposed a radical solution. The Fed should aim for no inflation at all. Tell us what you meant by this. I think you said this in an interview with CNN. Stable inflation is an oxymoron because it means it's not stable. What should they be doing instead?
It's funny to me. First off, radical is a good term. Radical comes from the Latin word for root, and it means to talk about something fundamental.
Sure.
And what could be more fundamental than assuming that the money you are required to use, it's legal tender, that the US dollar should be a reliable unit of account, that it should deliver stable purchasing power and serve as a dependable store of value. And if you look at the Fed's mandate, which they invoke often, it says that they are to achieve stable prices. It doesn't say that they should seek to deliver stable inflation, even low inflation. And in fact, if you look at the transcripts of Federal Reserve Open Market Committee meetings going back to July 1996, you will hear a fascinating debate between, at the time, Fed Chairman Alan Greenspan and Fed Governor Janet Yellen, discussing what does it mean to have a mandate to achieve stable prices. Greenspan said, I think it has to mean zero inflation. Zero inflation. And so if we're going to have an inflation target, that would be the logical choice. She argued that no, you need to, it's a grease the wheel model that her husband, who's a very prominent economist, talked about quite a bit, and is very Keynesian. And it's the idea that if you have some inflation through money illusion, you could end up carrying out your economic goals better. And it relies on this reasoning that, let's say there's an economic downturn, and if money was actually stable, if you had zero inflation, then many companies might decide to cut the salaries of their employees by, let's say, 1%. She argued that psychologically people don't like that. And so instead, that things would work much more smoothly in the economy if you had, say, a 2% inflation rate, because then you could give someone a 1% raise and they would feel like they had been rewarded and their good work had been acknowledged. But in fact, you were delivering a 1% cut in their real wages because of inflation. And she supported this approach by saying that her husband had conducted a survey of workers where it asked them, would you be okay to get a 1% increase if inflation was the same as that, just to see if people paid attention to real wages versus, say, a nominal increase. And she felt the results reflected more than half of the people saying, I would be okay getting a raise that kept me even with inflation. But she said, and this is in the transcript, you will all be happy to hear that when we asked economists the same question, would you consider yourself doing well if you got a 1% raise and we just had 1% inflation? Almost all of them said no. And it reflects that there was laughter around the table. I took this to be a moment of great hubris, that somehow economists were deemed to be more savvy, that they would recognize that a nominal increase in your wages that was dwarfed by an increase in inflation, or even neutralized by an increase in inflation, was no great thing. But what has stayed with the Fed and then became formalized many years later, because actually following this discussion at the Fed, it was decided not to say, if the Fed were to choose a low inflation as their target, as their definition of stable prices, because that's something that probably should go to Congress and be subjected to the opinion of the American people through their elected representatives. The Fed people at the time thought it was dangerous for the Fed to say that they were going to deliberately decrease the purchasing power of our nation's money unit, because they felt in some ways that made their job easier. So I think zero inflation is the appropriate target. And I would love the day that there's no difference between the real rate of interest and the nominal rate of interest, because the real rate of interest reflects real supply and demand for capital, instead of the Fed manipulating the interest rate in an attempt to respond to inflation and employment goals.
Let's take this thought exercise one step further. What if, hypothetically, if we were to have a command economy whereby the Federal Reserve, instead of targeting an inflation rate, targets a real GDP rate? So let's say they want a real GDP growth rate of, I don't know, 3% every year. And so if nominal GDP is 5%, that would imply that you need an inflation rate of 2%. So, yeah,
I
no?
I would not be a fan of that.
Okay,
I kind of cut my teeth when I first had a postdoctoral fellowship out at
yeah,
Stanford at the Hoover Institution.
sure.
When I was studying the money and banking system and current financial conditions of the Soviet Union. And that essentially, the system you just described, reminds me of what they had through Gosbank, which was having the banking system, which was part of the government, central government, dictating interest rates, handling all the loans, channeling savings of workers up to the government to cover the debt that the government had to issue, to cover the gap between revenues and expenditures from the socialist economy. And so for me, that would be a nightmare to have the Fed targeting and attempting to manage GDP growth and to go to any kind of system where they are distorting the price of capital to achieve economic objectives. I would rather trust the free market economy to make those determinations.
So that begs the question, why have a central authority or central bank at all? Let's just take the other extreme. We have one extreme in this prior example of a command economy governed by a central bank. Why not have no central bank whatsoever and no authority targeting inflation or growth or employment, and just leave everything to the free markets?
I think that is the question of the moment. And I think we're fast approaching some kind of resolution. It's a whirlwind. In this past week, we've had Elon Musk endorsing the idea that Chairman Powell at the Federal Reserve should be replaced by Ron Paul. Ron Paul, of course, the former U.S. representative from Texas, famously wrote a book in 2009 called End the Fed. And now Elon Musk, who is pushing the idea of auditing a number of government agencies across the board, has supported the idea of starting by putting Ron Paul in a position to audit the Fed, not in the way that I discussed earlier, but operationally, to bring up its practices of paying banks effectively not to make loans and of keeping $7 trillion in its own portfolio, and to put some kind of limits on how much debt the Fed can buy, how much money it can print, and to even look at its currency swap arrangements, which it relies on in instances of financial market meltdowns. There, I think, is a mood now to question the Fed. Whether it could go that far, I'm not sure. But you have people like Senator Mike Lee saying that the Fed has gone beyond its constitutionally intended powers. Basically, Congress farmed out its own responsibility from Article 1, Section 8 to regulate the money to this government agency whose record on delivering stable money has not been very impressive.
You've been an advocate of a return to the gold standard. Could a return to the gold standard like Bretton Woods be or act as such a constraint, like you referenced?
I would not go back to any prior system, but I would take the lessons from both the classical international gold standard from 1880 to 1914, and also the 30-year era of the Bretton Woods international monetary system, which was a gold exchange standard, something different than a gold standard. And that from 1944 to 1973 delivered decreasing inequality of wealth, fantastic productivity, broader workforce participation, and in general, delivered an economic boom, not just for the United States, but around the world. It was very powerful. And that was based on fixed exchange rates anchored by a dollar convertible into gold at a fixed rate. I think that delivered a level international monetary playing field that is really the only appropriate foundation consistent with the principles of free trade. I think President Trump has been brilliant in pinpointing currency manipulation as an unfair trade practice and has allowed our trade rivals to take advantage of our own productive capabilities, our own manufacturers and workers, and subjected them to very unfair competition. So that would be the lesson of the Bretton Woods era. But if you go back to that earlier classical international gold standard, now you're talking about the era of President McKinley, who we have heard, again, President Trump talk about with great respect. And he brought in the Gold Standard Act of 1901, and he really based his approach to economic growth as needing a sound foundation. And so he liked the gold standard for that reason. And during that era, the United States was incredibly successful in delivering new innovation and raising the level of prosperity and living standards across society in the United States. And I think that reinstituting in some way a new focus on the importance of sound money, and this would coincide with our renewed vigor to restore sound finances to the federal government, is part of what we're calling a golden era. A golden era corresponds to the kind of gold standard principles that a free market economy is able to flourish based upon, because you get accurate price signals. It supports individual liberty and people saying, I can decide what to buy, what to sell, whether to consume or invest, whether to save based on accurate price signals. It's the distorting of price signals through monetary policy that I think has caused the great interruptions in our economic well-being. And when you say it raises the very question of why do we need a Fed, that question was posed to Alan Greenspan, who was one of the longest serving Federal Reserve chairman, 18 years, about a year after he left. It was in 2007. He left in January 2006. He was asked that question by David Asman on Fox Business News. Well, why do we need a central bank? And instead of belittling the question or scoffing, he said, you ask a very interesting question. And he explained that if you're going to have fiat money, which means money is money because the government says so, it means I declare, so be it, from the Latin, you have to have some means of controlling the quantity. And further quoting Greenspan, he said, unless you have a currency board or a gold standard, we have seen throughout history that unrestricted money supply leads to deleterious inflation and negative economic consequences. And he ended up saying, quoting him, there are many of us, myself included, who believe we did very well on the gold standard. So I think that, that to me, coming from a practitioner, not a theorist, but someone who was in the arena, should have received much more attention. And I can even tell you that when I was a nominee, and I was being criticized for bringing up the advantages that from a gold standard that we should try to bring to a future approach to money, Alan Greenspan sent me an email saying, if gold is such a worthless metal, why does the US government and all other major governments hold so much of it? And so now this is becoming a big question as we look at the gold we do hold as the world's largest holder of gold reserves. It has come to be worth so much more than we're carrying it on our books as a monetary asset that I think it opens up new possibilities for recapturing some kind of dollar gold link.
Yeah, I want to touch on the gold-backed bonds that you talked to me offline about in just a minute. But just going back to what you said about Greenspan's comments, it's very interesting because I know Greenspan was a monetarist, and so his statement that you need some sort of governing board to limit the quantity of money, I presume rests on the assumption that the quantity of money dictates inflation. And so my question is, well, to my understanding, there's no legislation or a piece of law that puts a hard constraint on how much money that the Fed can print. So, if we have a Fed that is supposedly there to limit the quantity of money, but there's no constraint on how much money they could print, what is the point? I guess the constraint is inflation, but Powell doesn't even believe printing money causes inflation. So that constraint doesn't exist for every Fed, right? So what's your answer to this?
I might first object. I would not call Alan Greenspan a monetarist.
Okay.
My office
Right.
at Hoover was down the hall and up a few steps from Milton Friedman's. And Milton Friedman has also stated that a gold standard is wholly consistent with international free trade, but you can have at most either no central bank or one central bank. What we have, and now I'm talking about the international aspects, we have competing central banks, and most of our trade partners are in the current process of devaluing their currencies against ours. And so this I consider a highly unfair trade practice. But when you talk about our domestic economic approach in controlling the money supply, I don't think you can separate that from international, but let's try.
Mm-hmm.
No, Congress has put zero constraints on the amount of money that the Federal Reserve can print. And what the Fed did, it monetized the debt, particularly after COVID, over $4 trillion in debt that the Fed purchased. But then to prevent that from causing inflation, because the Fed's mechanism normally, when it buys Treasury debt from banks and broker dealers, it does it by just with a keystroke. It just shows that their cash account at the Fed went up by the amount of the value of the security that the Fed bought from them. So if a bank says, we'll sell you to the Fed $1 million 5-year Treasury security, the Fed says, done. And they just mark up that cash account and say, you now have an extra million in there. What happened when they bought these trillions in U.S. Treasury debt, the cash reserves of the banking system as a whole went up over 1,000 times from what they had been going back to the 2008 crisis. And then they just had hardly whittled that down, that amount of reserves, before COVID. It just takes forever. And so meantime, the Fed had received permission to pay interest on reserves as an emergency measure taken in October 2008. And they paid almost nothing for many, many years, which was another reason Bernanke at the time said this will not be a problem. People might think it's funny for the Fed to be paying banks not to make loans, paying them to keep their money in cash. On the other hand, we're only going to pay maybe 0.25%, but that's when the Fed funds, the main interest rate was zero or near zero. Well, once 2 years ago, we got up to this maximum rate as the Fed ratcheted up interest rates at record levels to combat what got up to over 9% inflation in July of 2021. It was costing the Federal Reserve so much money to pay those banks that, as I say, they started running at an operating loss. Just since March of 2022, so in less than the past 3 years, the Federal Reserve has paid commercial banks over $500 billion in interest. So the fact that it bought the debt and seemed to monetize it didn't really cause the inflation as much as the fiscal spending did, because what the Fed did is corral that money. The Fed has created the trillions, or currently still over 3.2 trillion in cash reserves sitting at the Fed dormant, doing nothing. But because it pays banks 4.4%, that's just an easy profit for the banks. They don't have to do anything. They don't have to have a loan officer. They don't have to guarantee against it. It's government guaranteed. They're getting 4.4% to leave money sitting there dormant in their cash account. So the Fed has corralled that money as base money so that it doesn't get into the economy, so that it doesn't cause inflation. And to me, the best thing the Fed could do is stop that practice. As I say, it was an emergency right to pay interest on reserves. It should quit paying interest on reserves, because then where would that money go? I think the bulk of it would go into other U.S. Treasury securities. We would not have this weird gap between the Fed's target interest rate and what's happening with the 10-year Treasury. Because to a bank, what's the difference between getting 4.4% on cash from the Fed, that's government guaranteed, versus having a Treasury, a 5 or 10-year Treasury that's also paying interest and is government guaranteed? If you didn't have that deal from the Fed, I think you would have two choices: put it into other government securities or actually make loans to the private sector. And both of those alternatives would be a much healthier thing for our financial intermediaries to be doing than to be engaging with the Fed, playing footsie with the Fed over the rate that they pay on reserve balances.
Okay, so you talked about the idea of a gold-backed bond. I think is an idea you're working on right now. And so two-part question: what is it? What does it do? And how would this solve any of the current problems that you've talked about so far?
Well, this is extremely current. Just last week, Treasury Secretary Scott Bessent, during an Oval Office interview when he was flanking President Trump, President Trump was talking about a sovereign wealth fund and asked him to expound upon that. And he said, over the next 12 months, we're going to do some amazing things. We're going to monetize the asset side of the U.S. balance sheet. If you look at the U.S. balance sheet, basically we have liquid monetary assets, and that's cash and gold, our gold reserves. And then you have illiquid assets in the form of land and buildings. If you're going to monetize those assets, the easiest one in the world is to revalue those gold holdings. The U.S. is the largest holder of gold reserves in the world, which is part of our legacy of having served as the anchor for that Bretton Woods international monetary system I mentioned earlier. That system officially ended in February of 1973. So the 261 million ounces that the United States government is holding are carried on the books of Treasury at the statutory rate or price of $42.22 per troy ounce. Because under Bretton Woods, the dollar, it took $35 to be converted into an ounce of gold. And as that system started to fail because the U.S. was inflating, we tried to chase it higher. We thought of resetting the rate. Paul Volcker was involved in this, resetting it at $38 an ounce or $41 an ounce. Finally, we got to $42.22 an ounce and could not catch up. The U.S. dollar had inflated to where the market price of gold was outrunning any convertibility rate that we could attempt to put into stone. So we carry that money, we carry that reserve asset at a total value of $11 billion. If you mark to market those 261 million ounces at, say, $2,900 per ounce of gold, you are approaching 800 billion. Let's say 756 billion at today's price, and it's been higher than that in the last day or so. A windfall profit potentially worth $750 billion is getting the attention not just of the Treasury Secretary. We're seeing a bid to make Bitcoin a strategic reserve asset. That plan is also based on taking a piece of that revaluation and buying Bitcoin with it for the U.S. government. I don't think Bitcoin needs the help. I love alternative currencies. I don't want to do anything to inhibit the crypto community and the whole psyche and culture of decentralized finance. But gold is legally part of our foreign reserves, other currencies and gold. So I would rather use the gold to have it serve as collateral for a gold-backed bond long-term, and I'm specifically saying a 50-year gold-backed bond, because it's been just over 50 years since there's been any link between the US dollar and gold. If the US Treasury, as an initiative ordered by President Trump, said we are going to formally have a new Treasury security, we'll call them Treasury trust bonds, that give the purchaser, the bond holder, the right to redeem at maturity the principal amount in either the face amount denominated in dollars or as a portion of gold, I think that would get the world's attention. It could potentially end up being a security very much like a TIPS bond, a Treasury inflation protected security, which the Federal Reserve looks at to get a sense of aggregate expectations about inflation, but based on the consumer price index. Because a TIPS bond reimburses the bondholder for the impact of inflation defined by an increase in the CPI. A holder of a Treasury trust bond would be able to be reimbursed for loss of purchasing power in terms of gold, which could be a surrogate for the real economy and for commodities. It would just be an option for investors in US Treasury debt who might say, I want to retain purchasing power. I'll make a loan to the US government. But at the end, I see the price of gold as a surrogate for purchasing power. And so I would like the option at maturity to be paid out in a pre-specified amount of gold rather than the face amount. And so you now put the burden on the US government on both monetary and fiscal policy to do better than market expectations with regard to preserving the purchasing power of the dollar. And I think truly aiming for stable prices as a mandate of the Fed and in conjunction with a balanced budget.
Sorry, just to note on that, it would be possible to redeem for gold at the spot price at maturity, or
no, it would be preordained.
Okay.
But what we could say is, let's do this example, and I'm going to say 50 years, and for a reason. But a 50-year bond was considered under Treasury during the previous Trump administration, because I was involved in the transition as lead advisor for international affairs at Treasury. And 50 years was considered, but they didn't go that route. They still go with 30 as a maximum. But other countries, France has a 50-year bond. It's not that unusual. You could do it. But an easy way to think of it is, let's say gold is $2,900 today. Would you rather have $2,900 today or an ounce of gold? Your answer might be, I'm indifferent, because that's the price. All right, 50 years from now, would you rather have $2,900 or an ounce of gold? And you would say, I'm sure that an ounce of gold will be worth more, because even the Fed, if it achieves its target, we're talking about debasing, say, $1 becomes 37 cents in 50 years at 2% inflation. So you'd clearly rather have that. If you put $2,900 as the face amount, the principal amount, everyone's going to want to have the gold in 50 years. Is there some amount that you could put that would be the equivalent of someone holding a traditional Treasury security, but also a call option on gold, the future price of gold? And if the US put its gold as specific collateral to ensure that every bondholder could be paid off, then to me, what you're looking at is people focusing on the difference between a fiat money Treasury security and a treasury security where the dollar is literally as good as gold, which is what we had for so many years in our country and during its most successful times. And so I believe a gold-backed bond, the pricing, the maturity, these are open options. But I think we could start by securing the windfall profit and revaluing these, which would be an 800 billion shot to either the sovereign wealth fund or to treasury revenues, or however you want to hold that windfall gain. But you would be preventing the gold from being sold, which I think would be disastrous. Anyone who would want to just sell the gold and use the money now, and until you get the budget in order, that would be sending it down a rat hole, in my view. But if you used the collateral of these revalued gold reserves to back a formal treasuring offering, it would not be the largest segment of treasury debt out there, clearly, but it wouldn't be the smallest if you used all of the gold to back a new offering. You could decide whether you pay interest in dollars or gold leading up to that. You could decide if it is a zero coupon bond. That's what I recommend. It could be initially made available as a type EE savings bond. You could limit it only to U.S. residents with Social Security numbers, and it's the kind of thing maybe people would buy for their grandchildren. Or you could issue stable coins or authorize stable coins that hold as reserves these particular treasury securities, or that hold some percentage among their portfolio of treasury securities, the ones that are backed in gold. You could start to magnify the impact beyond just the value of our gold reserves. And I think this would actually prompt other countries, including China and including European Union countries, because they own large gold reserves, to issue the same type of bond. Now you're going way beyond just doing a novelty issuance, symbolic and powerful as a marker for future sound finance and sound monetary approaches. But you could be setting up the beginning of a new Bretton Woods type system, because if a number of countries, the primary trading partners in the world, participating in a system where they all issued sovereign government bonds that could be redeemed in gold at a future date, then now you're setting up a foundation where all currencies are convertible into the same neutral reference asset, i.e. gold. That is very much capturing the major advantage of the prior international gold standard. Everyone had their own currency, but it had to be defined in terms of a specific weight of gold. So I think you would have the beginnings of stable exchange rates, and the closer you got to the universal or comparable redemption dates for maybe an array of sovereign debt issuances by governments, you could use this even as a way of setting up a trading partnership only among countries willing to abide by some kind of a gold redeemable sovereign obligation. And or those same countries, if they weren't willing to do that, you could say, well, then you understand that any tariff we would direct at you has to reflect the devaluation of your currency in terms of gold relative to the devaluation of our currency in terms of gold, so that it doesn't become an exchange rate battle of deliberate currency manipulation. You can call it no fault, but you can reflect the fact that as much as our own dollar has devalued against gold in the last 10 years, the currencies of our top 5 trading partners, Mexico, Canada, European Union, China, and Japan, have devalued more in terms of gold. And if you just wanted to apply a tariff saying we're just leveling up the monetary playing field, and the fact that your currency distorts the competitiveness of our own manufacturers, and we have to account for that to make it a level international monetary playing field. They should have to accept that. So I think that a gold-backed bond may sound like a novelty, but in fact, the potential to become very useful instrument both to the Fed and for our trading posture, and with regard specifically to tariffs and what is the rationality for tariffs, reflecting the differential currency impact. I think it could be extremely powerful.
Very interesting. Let's follow up on this development as you and your colleagues work on it some more. But I appreciate your insights, Dr. Shelton. Where can we learn more about you? You referenced you have a book, by the way, called As Good as Gold. Where can we find that book, for example?
Well, it's Good as Gold: How to Unleash the Power of Sound Money. It's published by Independent Institute. It's currently on 3 of Amazon's bestseller lists for different categories: monetary policy and economic development policy. So it's easy to find. It's selling well. I might say that any royalties will go to Independent Institute. That book gives the details for exactly this proposal.
Excellent. So we'll put the links down below and to the Independent Institute. Thank you for your time, Dr. Shelton. We'll speak again soon. Thanks for returning to the show.
Been a pleasure. Thanks, David. Bye-bye.
Thank you for watching. Don't forget to like and subscribe.